In focus today, guys, is really this rotation out of semiconductors, the potential for the Mag 7 to capture some of that. JP Morgan had a note out about that this morning, saying that retail investors in particular are kind of following that trade, with NVIDIA, Tesla, and Microsoft leading the July buying here. Josh, you own NVIDIA and Apple. What do you make of this rotation dynamic? How much do you think it has in terms of legs?
Look, you could take that JP Morgan retail radar and put it back in the envelope, and I can just Kreskin-like predict what that's going to say next week. I'll just look at what happened this week. I mean, there's no information there. It's not important. I think that the key to this market this summer is stop acting like a thirsty lunatic. No more thirst. We're grown men and women, and we need to comport ourselves. The thirst to own the it trade every second of every day. And it's not even enough to just own it. You need to own it 2x in an ETF, and that's not even good enough. You need to own it with a 0-day till expiration option. This is what's killing people right now. And if you're not playing that game, your portfolio looks amazing. The median semiconductor stock in the SMH is in a 22% drawdown from its own high right now. 44% of the SMH names are in a drawdown of 25% or worse. That's real money. These are big drawdowns, considering the fact that we're in an S&P 500 that's within a couple of percentage points of record highs. Imagine having put yourself in that position because of how thirsty you are. There are only 3 semi names right now that are even within 10% of an all-time high. Only 3. The rest of them have been knocked out of the box, and people, they feel like, oh, well, I'll do the DRAM. DRAM's in a 34% drawdown. It's actually worse. Micron, 29% below highs. Western Dig, 36% below highs. SanDisk, a little bit worse. This idea that you have to be all in to whatever's working right this second is kryptonite for portfolios. I was talking offset just now. I know a guy that moved a multi-million-dollar portfolio just to get the SpaceX IPO, like broke a relationship with his advisor at a major bank, moved all the money to another advisor. I don't know, what did he get, 500 shares? Now it's below the IPO price.
Locked up.
Stop acting thirsty. It's going to kill you in this tape right now. It is not the time for that. You missed that time. It was May, June.
Yeah, I know, Shannon, you've been looking at momentum crowding at a 40-year high, concentrated in tech, financials, and industrials. When you see indications like that, you know, what do you think, in using Josh's analogy, investors should be doing to kind of quench their thirst and move on?
Well, I think the challenge is, too, is that, you know, we saw 24, you know, and 25, and there was clearly a very concentrated set of stocks, the Magnificent Seven, where you could essentially press that easy button and get access to the front edge of this AI trade. And I think what happened in the second quarter is that investors were seeking that next easy button, that next concentrated basket of stocks that would provide them that same type of appreciation and have a longer tail. And the reality is that we're in a very different phase in terms of the AI implementation cycle. We're looking at the fact that we have built a significant amount of capacity. This extended period of capital expenditure is likely to start to broaden into industries, sub-industries, sectors. The companies that are going to implement AI have this innovation really impact and continue to drive earnings and margin over the course of the next 6, 9, 12 months. And I think the challenge is now is that, to Josh's point, everyone was crowding into that kind of second basket of hardware, you know, chips, CPU, optical. The reality is that this next phase is going to have a much longer tail. The benefits are going to accrete much more broadly and perhaps more modestly to individual companies. But having that diversification in your portfolio, looking at what are the next areas, financials, industrials, healthcare, wherever you think that that's going to be, the benefits of AI are going to accrete more modestly, but more broadly. And trying to find this next basket and be able to capture that, to Josh's point, if it's already already run, you're likely not to be positioned to benefit from that on a go-forward basis. And so I think people just need to take a big step back and understand that the value of AI, that front edge, that easy button, that's over. And you need to be much more selective in this next phase to find the companies that are going to have 2, 3, 4, 5 years of benefit accreting from what they're investing in CapEx and AI right now.
Well, those who would be in defense of the semiconductors would say this has been an earnings-led upside, and that they have just these pricing, benefits that they've been able to employ here and raise prices, protect margins, expand margins in many cases, and that's why people have been riding it to the upside. Malcolm, I'm curious what you make of that argument, and do you think that those benefits have all been seen and have all been priced in at this point?
Yeah, based on that, you're supposed to buy the rumor and sell the news, but we're right now seeing people selling the rumor because we haven't gotten the earnings to confirm whether or not that 27% growth this past quarter, from the S&P that we're expecting is actually going to come to fruition or something even better. So I think it's odd. I think to the point that Josh is making, that folks aren't willing to at least wait and see if those trades actually pay off. Right? The response to Taiwan Semi's earnings, as an example, is extreme in comparison to what you would expect at a moment where just 2 weeks ago, everyone loved the semis, it seemed like. Now, where most of the earnings growth is coming from 3 semi names, right? You have Micron, Broadcom, and NVIDIA that supposedly were going to save the day. We don't even know what those numbers will look like. ASML saying we're going to raise prices, and the market hasn't responded as negatively to that as they have to Taiwan Semi. NVIDIA is saying we got to raise prices, and the market's not responding negatively to that today necessarily because they're almost at their all-time.
The earnings could be great. The problem is, to your point, we don't get to actually invest in the earnings. We get to invest in the
stock.
Exactly. We get to invest in the response to the earnings, and if the response happens before the print, well, you missed it. This is the message of the market right now. We all know these earnings are going to be blockbuster. Everybody knows. Nobody doesn't know.
But I think what you're saying, though, supports the thesis that I've been sharing for a while. What I'm referring to is crazy town, where we are right now, right? We're constantly having this debate about whether this feels more like 1997 or 1999. And I'm on record as saying it feels a lot more like 1999. And one of the reasons is because the thing that was driving this whole ship was the CapEx. It was the idea that all of the hyperscalers would continue to throw more money into the dirt to build these data centers because the demand is so strong that it's just going to work itself out. And now what we're seeing with Meta suddenly walking back some of its expectations and saying we're going to turn that compute over to whoever's willing to lease it from us. And that's the second one, because XAI was the first one. They were lucky to have a friend in Anthropic who was willing to come and lease that additional compute from them. Who's next? Oracle, right? So I think that what we're seeing in real time is the hyperscalers acknowledging that they probably have overbuilt, unless you are Microsoft, Google, or Amazon, who's got the ability to also run that private cloud that can consume a lot of that already.
Jim, I want to bring you in because you own Micron, right?
Mm-hmm. Micron apparently only trades in increments of 5% a day or more. I got news for everybody listening. That's not normal. That's not, okay? That's not how stocks trade. It's not worth $50 billion more or less on any given day. But what we've got here, and what Micron, Leslie, is an indication of, is there's a mismatch right now between the fundamentals that we're all talking about with the markets and the technicalities. Note my use of the word technicalities, not technicals. The charts are whatever they are. Josh, you can help me as much as you want on that, but that's not the point. The technicalities that I'm speaking of are things like this massive supply of capital raise going on in primary markets and secondary markets. Things like margin, and Shannon, I think you used that word, but it may have just been in terms of profit margin. Margin debt is what I mean. If you look at what happened in Korea 3 days ago, 320,000 retail accounts got liquidated on margin calls. I mean, that is an incredible blow up. And that explains why a lot of stocks in that market, a lot of the chip stocks have been hammered. As they say, when the margin clerk comes for you, he doesn't ask if you want to work the order. He just sells your stocks. Period. End of story.
They just banned the leveraged single stock ETFs in Korea.
Good.
Yeah.
Good. Does anybody disagree that that's a good move?
Well, we do. In America, we're going to approve 3X.
Yeah.
So
well,
we're going the other way.
And guess how it's going to end. I mean, all four of us know how all 5 of us know how it's going to end, but it's just a question of time. These technicalities, by the way, just to lump more on this, I think we know this, margin debt in the U.S. is 55% higher now than it was a year ago. I'll grant you, the stock market's higher, but that's a lot of margin debt. This is what I mean by technicalities. It's a tough time. When we see these rotations every day like this, and Micron, Leslie, is a great example, it tells me this is a market in need of a correction, and it's probably going to get one.
And that margin is not balanced across the S&P 500. We know which equities are more likely to be owned with a lot of leverage and which aren't. And that's exactly what you see playing out on your screen in front of you. There's a reason why the banks, for the most part, were able to react well to their earnings. People aren't sitting in 2x JP Morgan.